What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and learn how to think critically about the systems of power shaping our world. My guest in this episode of Hidden Forces is Louis-Vincent Gave, the CEO and co-founder of Gavekal, a company that started as an independent research firm with a focus on Asia and has evolved since to include fund management and data analysis services. In the first hour of our conversation, I asked Louis what he thinks are the most important trends set to define the investment landscape in the years ahead, including why he believes that the US and Europe are set to undergo a long period of structurally high inflation, while China's economy is set to experience what he describes as a deflationary boom, driven in part by rapid advancements in key industries like semiconductor manufacturing and electric vehicles. In the second hour, we explore why Louis believes that the American Imperial model of dollar recycling is unsustainable, and why de-dollarization is a prerequisite for the re-industrialization of the United States. We also discuss whether or not America needs an industrial policy to achieve this and help reverse the multi-decade financialization of the American economy that has helped drive up asset prices relative to their underlying income streams, exacerbating the wealth divide and destabilizing the country's political system. If you want access to that part of the conversation and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second hour of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Lastly, because this conversation deals with investing, nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this thoughtful and educational conversation with my guest, Louis-Vincent Gave. Louis Gave, welcome to Hidden Forces.
Thanks for the love for having me. Very nice to meet you.
Yeah, I didn't try to go full out French accent. How would you say your name in French if you're speaking to a French person?
Louis-Vincent Gave.
Well, it sounds so much better. It's not just a cliche. So, Louis, it's great having you on. What prompted this conversation was actually my most recent episode with Paulo Macro and Le Shrub. And I read a bunch of your opinions through Paulo because he was referencing them in many of his pieces. So I was like, this would be kind of like a normal transition, which would be to speak to Louis afterwards. So before we get into today's conversation, which is going to be, I think, mostly about China, but there's a lot of other stuff that you write about and you explore in your research. I'd love to learn a little bit more about you. Like, how do you describe what you do? And then to that point, why do you think you're good at what it is that you do?
Oh, I don't know if I am good. I wake up early morning and try to be good, but we have a bit of a hybrid firm. It's a firm I started, my father, Charles, and a friend of ours called Anatol Kaletsky some 25 years ago now. We started off as a pure macro research firm, publishing macro reports and basically selling them to large institutional investors. And pretty early on, we felt, that China was going to be a pretty big deal. We started the firm in London. We moved to Hong Kong and then opened an office in Beijing on the premise that, China was going to be a big, important factor for macro for the coming years. And so we were very lucky in terms of being in the right place at the right time. Pretty early on, starting 2003, 2004, 2005, China really started to take off. And there were few people at that time doing what we were doing. So again, it was a question of being right place, right time. Parallel to this, starting around 2005, we built a money management arm where we started off with an Asian equity fund. And then when China basically started to open up its bond market, we started to get pretty big into Chinese fixed income as well. Then in 2011, We also bought a stake in a private wealth firm in the US called Evergreen Gavekal. You might see that on social media. And so we sort of added a third leg to our business, aside from asset management, aside from research, a wealth management arm that initially was just in the US and that has now become a little more global. We bought a couple of years ago a wealth manager based in Mauritius. So we're sort of a hybrid firm. We do different things. Obviously, since we started, we've grown from just the initial 3 partners to now 8 partners working in the firm. Our headquarters, though, remains in Hong Kong. Our second biggest office does remain Beijing. And I do still spend a lot of time in China. And, I still find it absolutely fascinating. I think it's one of the most important macro story of, frankly, of humanity, how 700 million people came out of poverty within a generation is, to me, worthy of a lot of ink, a lot of studying. It's a testimony for perhaps future generations.
So I agree. It's the most remarkable economic growth story in the history of humanity, and it continues in some ways. So you guys write a lot of stuff. I mean, you publish a lot. I've seen how many times would you say you write an article every month? How many articles do you publish, you personally?
Personally, less than I used to, because the team has grown, and we try to limit ourselves to no more than 3 publications every day. So we have a set schedule as a firm. We start off with a daily, which is usually 2 to 3 pages at most. And the idea is to take one idea, something big that happened in the previous day or two, and that could have an impact on financial markets. And so that's our daily, short, punchy, to the point. The idea is, you can basically read it on your way to the bathroom. We write a think piece as well. We have one think piece a day, and then we might have a second think piece specifically linked to China with our China product. So I highlight this because we now have a pretty big bench of analysts, a big bench of people looking to contribute, and we're all competing to try to get published. And very often, I write pieces that end up on the floor because there's better pieces published by some of my colleagues. Charles right now, my dad, who still writes every now and then, is really pissed because he's got 3 or 4 pieces in the cupboard that have been there for like 2 months, and he clamors to get them published. So I highlight this to answer your question. I probably write, I would say, 5 or 6 dailies a month, and then 3 or 4 think pieces a month, ideas pieces. So I probably publish anywhere from 7 to 10 pieces.
Yeah, I mean, that's a lot. You guys put out a lot of information. So, as I said, while I do expect us to talk quite a bit about China, you guys cover a lot of different trends. And so I feel like the appropriate question to maybe start this conversation with is, what are the most important trends that you've been focused on over the last several years and that you expect to remain focused on over the next several? In other words, which are the enduring trends that define the investment landscape in your opinion?
Everybody's got different processes. And I start off with a very simple idea that there's 3 prices that determine everything: the price of energy, the price of the US dollar, and US interest rates. And that as investors, it pays to have a pretty clear and intelligent view on any one of these 3 things, because these 3 prices, again, will determine pretty much everything else. And now, having said this, the other sort of starting point for me personally is that economic activity is energy transformed, that energy matters a lot more than people give it credit for, and that there's, of course, massive interaction between the world of energy and the world of currencies. So I do spend a lot of time looking at energy. And for me, to answer your question, perhaps the single most important macro development of the past decade or so that people just don't spend enough time on has been the US shale revolution. I wrote a book about it back in 2012. The book was called Too Different for Comfort. And, as I look at it, the US went from producing 5 million barrels a day to 13 million barrels a day. It basically added one Saudi Arabia. And as it did, it made for a stronger dollar. It made for lower inflation in the US, which allowed the Fed to keep monetary policy much too easy for far too long, allowed for a massive re-rating of the US, et cetera. And amidst all the talk of US exceptionalism, for me, that's the part that people don't focus enough on. Now, this is where it gets fascinating, is the US in the past decade has gone from 5 million to 13 million barrels per day. The big question for me is, where do we go from here? Does the US basically keep the massive comparative advantage it has built in energy? And if it does, then happy days for the US economy, happy days for US markets, happy days for US policymakers. Or is this massive comparative advantage that the US had starting to stall? Starting to stall because not enough has been invested, because policies haven't been that friendly to the energy space. To cut a long story short, do you think over the next 5 years the US finds another Permian or not? I don't. I think right now nothing is being done to find another Permian. And therefore, it makes for a very, very different world. A world where the US goes from 5 to 13, and a world where the US goes from 13 down to 12 makes it a very, very different world with impact on the currencies, impact on interest rates, and impact eventually on policies as well. So that's one massive trend that's out there. The other massive trend, of course, and I'm sure you talked about with Paolo. I must admit, I didn't listen to the talk yet with Paolo and the Shrub. I'm a big fan of both. I subscribe to both Paolo and the Shrub Substacks. They're both tremendous reads. I think they have a great pulse on the markets. But look, the biggest trend out there, which partly goes with the energy story, is that we've moved from a fundamentally deflationary world to a fundamentally inflationary world. And in an inflationary world, portfolio construction is massively, massively different. We're seeing it every day. In a deflationary world, bonds are the natural diversification for portfolio. In an inflationary world, they're not. In an inflationary world, energy is the natural diversification for portfolio. Failing that, precious metals, and failing that, strong currencies. And that brings me to the third big trend out there, is that for the past decade, partly thanks to energy, partly thanks to monetary policies, the US dollar has been structurally strong. And I firmly believe that with the fiscal policies that are being implemented in the US, frankly, the monetary policies that are being implemented in the US, we've now had 3 consecutive years where inflation has been above 3%. And instead of sounding hawkish, the Fed does its very best to sound dovish. So I think we're now in a structurally inflationary environment, again, that has huge consequences for portfolios, for currencies, for lots of different things.
So let's tackle the deflation to inflation paradigm first. What is it specifically that you point to that makes it so that you believe we are in a structurally inflationary environment?
Well, the first, of course, I would say the runaway budget deficits everywhere. My very favorite economist is a French economist called Jacques Rueff. And Jacques Rueff was de Gaulle's advisor in the 60s. It was actually him who advised de Gaulle to get the gold back from New York and got the Americans pretty pissed off. But, he was looking at the twin deficits that the US were running and saying, look, this is just simply not sustainable. The US is going to have to devalue against gold. Here's how I'd put it today. We're 3 or 4 years into a global economic recovery following COVID. Pretty much anywhere you care to look at, except perhaps China, you've had nominal GDP growth meaningfully above structural growth trends. This is true of the US, it's true of Europe, it's true of India, it's true of Japan. Now, take any one of these countries. The US today is running budget deficits of 6.5% of GDP at a time of full employment. India is running roughly 4%. China is running roughly 4%. Japan is running roughly 4%. France, my home country, is running 5.5%. Now, Jacques Rueff used to say that inflation is its expenditures that give no return funded with money that does not exist. And this is exactly what we're seeing everywhere. We're seeing the subsidizing of expenditures that give no return, whether you call them magic windmills or magic mirrors to get energy in a highly inefficient way, whether you call them massive increases in defense spending, whether you call them massive increases in social spending. Everywhere you care to look, you see big increases in government spending, and at the same time, massive discomforts with population who feel, hold on, you got runaway budget deficits, my taxes keep going up, and against that, public safety is getting worse. Against that, public education is getting worse. Against that, public health care is getting worse. And so, this inflation is subsidizing expenditures that give no return with money that doesn't exist. You'll be hard pressed to find a country today where, frankly, this isn't the case. except perhaps the one country that doesn't suffer inflation today, which is China. In China, you have had big increases in debt, you've had big increases in government spending, but you're at the phase of their structural growth where people can see where the money's been going, right? It's been going in high-speed railways, it's been going in dams, in ports, in airports, it's been going in infrastructure. I'm older than you are, I'm 50. I started my career, let's say, for the sake of argument, 30 years ago. When I started, the US government had 4 trillion in debt. Today it's got 34 trillion in debt, with debt growing by 1.5, 2 trillion a year. Now, here's the thing, in the past 30 years, what did you get for that money? Where's the Hoover Dam? Where's the new interstate highway system? I think the last major airport that was open in the US was the Denver airport in 1991. So, you've had massive increases in debt that have primarily funded expenditures that give no return. It's gone into social transfers, it's gone into silly military operations, and that's the very definition of inflation. And so you see the inflation all around you. I think it's delusional to not see it.
Is it fair to say, it's hard for Americans to think of America as an empire, because when you're living in an empire, you don't see yourself as an empire if you're a country like the United States. But in some sense, is it fair to say that what we're talking about here is also the American imperial economy, where you had the American market being an import destination, running current account deficits? The dollar was very strong. And so what's happened is we're now in a world where the military balance of power is changing, and that threatens to undermine the symbiotic economic relationships that built up around American hegemony, especially post fall of the Soviet Union. Does that resonate with you, that description?
It does. And look, I don't want to be sounding like I'm touting my own books, but I wrote a book about this back in 2019 called Clash of Empires, which is available on our website. I think the e-version is for free if people want to download that. We can go down the wormhole of empires, and I'm happy to, wax lyrical on it for hours. What I would say is this, is that, historically, you've had two kinds of empires. You've had the land-based empires, so you build roads, you build railways, and very clearly this is what China's aiming towards. The One Belt, One Road, the Silk Road Fund, the Asia Infrastructure Investment Bank, all these investments that China's making is really an attempt to be a modern-day empire. Fundamentally, that's what empires often do. Empires build roads. That's why in Europe we say all roads lead to Rome. Empires build roads to bring commodities in cheaper, transform them into higher value-added goods, and push them out to the rest of the empire. That's always what empires have tried to do. That's what Britain did. That's what France did. That's what China's trying to do.
Terrestrial or naval, through waterways or land, presumably.
That was going to bring me to my second point, which is that you're absolutely right. You've got the land-based empires, i.e. Rome, and you've got the sea-based empires, i.e. Carthage in the old days. Now, land-based empires are very costly to maintain. You need to, manage the road. You need to put stations. If the US is an empire, it's obviously a sea-based empire. It controls the world's oceans. Now, having said this, and this, if you take a step back, there's a couple challenges to this. The first challenge is the US is a very weird empire, and I would say perhaps a reluctant empire. Again, if you start off with the premise that the goals of empires is to bring commodities in cheaper, to push out finished goods to the outer realm of the empire, the US was undeniably doing this in the 1950s and the 1960s. There's no doubt that's what the US did. That was what the Marshall Plan was about. Here, we'll lend you money, and you're going to use this money to buy Caterpillar machines and to buy, General Motors cars and whatever else. But the US stopped doing that like 30 years ago. The US stopped being an empire where it's like, we're going to bring in the commodities here, transform into higher value added goods, and ship them out to the rest of the world. The US doesn't do that anymore. The US, as I think we're seeing now with this Ukraine war, the US no longer really is an industrial power. The Ukraine is running out of 155 millimeter artillery shells simply because neither Europe nor the US can produce them anymore. We simply do not have the manpower, the factory, the expertise to produce 155 millimeter shells that we were producing like at great scale during World War II. We're not even capable of doing that today. Or maybe you say, well, we choose not to. But the idea that, the US is no longer basically an industrial power. So can you be an empire and not be an industrial power? I think would be my first question mark. The second question mark is, as you pointed out, the US is a sea-based empire, which was great because that was a very low cost way of being an empire, except that we now know that a couple of guys with a drone can threaten entire sea lanes, as we saw with the Houthis. But it was something that really we'd seen before with the Armenia-Azerbaijan war, and that now that we've seen with Ukraine, that basically controlling seaways thanks to massive fleets and aircraft carriers and destroyers, etc. When these can get taken out by a $50,000 drone, all of a sudden the equation changes dramatically, and your ability to control all of the world's waterways is perhaps no longer the same. So I think we're seeing some profound shifts today that make for a very, very different world.
So on that point, if you had to sort of describe what the nature of this relationship is between the US and China and how it has evolved, what is the story you would tell? And how much of this is an appropriate response on the part of the United States, for example, to try and prevent China's military rise? And how much of it is an overestimation of the threat that China poses that risks backfiring on the US?
Look, I think the entire relationship changed with the arrival of Xi Jinping to power. I think pre-Xi Jinping, the US saw China as this sort of cheap manufacturing hub, and they're going to produce the microphone that you're speaking on today, and they're going to produce the shoes that I'm wearing, and they're going to do this at very low margins, and we're going to capture most of the margins through marketing, through sales, and keep those margins in the United States. And that worked great from roughly 1982 to 2012. And then in 2012, if you remember, Xi Jinping comes in and does two things. First, he starts talking an imperial talk, like the One Belt, One Road, the Silk Road Fund. Remember, every Chinese president before Xi Jinping was inward looking. It was like, you came in and you didn't really care what was happening abroad. There was so many problems at home. It's like, whatever, the foreigners can take care of themselves. I'm focusing domestically. And then Xi Jinping comes in and says, you know what? We're going to build roads in Africa. We're going to build big ports in the Middle East. So, that piques up the US interest. It's like, well, hold on. You're supposed to be the cheap manufacturing center. You're not supposed to be an empire. So that's number one.
Is that also because implicitly the United States saw China within the orbit of American empire, right? There was a unipolar power, right?
Yep. China was the manufacturing center of the US empire. Then China comes out and says, we're going to have our own empire. So the US already is like, wait, what? Then the second thing that I think Xi Jinping did, if you remember, he had this big China 2025 dream, where it's like, by 2025, we've got to be able to produce our own commercial airplanes. We have to be a car exporter. We want to be a telecom switch exporter. And not just we want to be the number one in the world at exporting cars. We want to be the number one in the world at exporting telecom switches and earth-moving equipment and tractor and whatever else. At which point the US says, hold on, like, we liked you when you were producing socks and underwear, but if you're now going to be competing with Cisco for telecom switches, and if you're now going to be competing with John Deere for tractors, and if you're going to be competing with Ford for cars, and you're going to be competing with Boeing for planes, then we have a problem. You're supposed to be low value added stuff. You can't be moving up the value chain. And so we're going to, prevent you from doing that. We're going to make sure you don't get access to semiconductors. We're going to impose tariffs. And, as this has happened, what the US has found, I think, to its dismay, is that instead of collapsing, the Chinese economy took the punches, and they were pretty big punches. Took the punches and kept going. And China, pre-2025 has become the world's biggest car exporter, and it has become the world's biggest tractor exporter, in spite of the punches. And I think that's the situation we're in today. Now, the good news is, we're recording this on May 14th. The US has just announced 100% tariffs on Chinese electric vehicles. It's just announced 50% tariffs on Chinese batteries and on Chinese solar panels, which is great news. I think that's terrific news, because for the past 10 years, I was shaking in my boots that we lived in a climate emergency. I was told that the world would end in 5 years' time if we didn't dramatically change our ways. But now I've just found out that actually we don't need to change to electric vehicles, and we don't need solar panels everywhere, that the climate emergency must have been pushed back because, we can afford to have all these tariffs on China, even though the world is supposedly burning. So I woke up with a great sense of relief this morning.
So, I mean, that might be an opportunity to go back to the conversation about energy and how much of your opinion on shale is a result of insufficient capital expenditures and how much of that is because the private sector isn't investing enough, or how much of it is because of government regulations or forward guidance around the energy transition, ESG, stuff like that. But let's just bring it back to this conversation. This kind of where obviously this is not doesn't fit neatly into the investor bucket, but it's sort of relevant for the larger framework. From the European and American perspectives, does it make sense to move away from the neoliberal consensus of largely unconditional support for free trade and open markets, given the fact that they have been competing with a China which has been very good at industrial policy, very good at using state subsidies? I mean, the EV sector is a great example. They didn't become the number one EV exporter because they had some really great libertarian market, free market principles. They had it because they had very competent industrial policy.
I disagree on that, actually.
Well, great, because this is a good opportunity to have this conversation because they've really crushed it on EVs. So what explains the rapid advancement in EVs and how they've taken the global economy by storm in that area? So much so that it's terrifying the Europeans, and the Americans have put tariffs on non-existent imports. I mean, it's not even an area of competition right now. So how do we explain that?
So I think the narrative right now in the Western world is the one you just described. It's, oh, China's really good at giving government subsidies and we suck at it. In essence, that's the narrative. I look at it a little bit differently. I would say that first and foremost, being an industry, you build a whole ecosystem. That you don't wake up one morning and decide, you know what, I'm going to throw a bunch of money at this manufacturing. Look, this is what the US is trying to do right now with semiconductors, right? They've decided, Taiwan and South Korea have gotten to be much better producers of semiconductors than us. By the way, did TSMC get a bunch of subsidies from the Taiwanese government? No, it just got good. It got good because Taiwan, like China, has a whole both tech and industrial ecosystem. Progress in industry is made mostly by workers who tinker, who make small changes. Now, let's talk about the EVs, since I do agree with you that it's a great example. Today, you do have a number of Chinese brands that are breaking out on the upside. And they're breaking out on the upside with tremendous vehicles, whether you look at BYD, whether you look at Polestar, there's a list of them.
And also, the huge price differentials too, right? The Chinese
huge
EVs.
Price differentials. But there's also a huge list of cars on the side, roadkill. Like, you've had tens of bankruptcies of car producers in China over the past decade. Tens. So I would say that, the difference is perhaps that in the US, you're down to 3 car producers, that it's a far less competitive landscape as opposed to China where you've got dozens. In the US, if you go back to when cars were first introduced at the beginning of the 20th century, the US had 100, 150 car producers, and they were egging each other on, and you had people tinkering in their garages and making things better, et cetera. And eventually, Ford got to be better than everybody else, and so did General Motors, and they cleaned up. They took over competitors, or the competitors just went bust. And as you get big, you get fat, you get lazy, you get stupid, and the more protectionism you get, the more fat, lazy, and stupid you can be. Now, you look at China, you've had literally dozens of electric vehicle brands being launched in the past 15 years or so, and you've had dozens die by the wayside. And today what you have are the survivors, the BYDs of this world, that are lean, mean fighting machines. Now, does China have comparative advantages in that it might not have the same environmental rules we have in the West? Absolutely. Does it have cheaper labor costs? Absolutely. Have there been subsidies given to electric vehicles? Yes. And have there been sort of governments ordering fleets of electric vehicles for the Ministry of Defense and ordering fleets for this ministry and that ministry, et cetera? Absolutely. But the West does that as well, right? I mean, it's not as if our electric vehicle industries in the Western world haven't benefited from enormous subsidies. Would Tesla have existed if it hadn't been for government subsidies, especially early on in its life? So we can sit around and say, oh, China's successful just because of subsidies. But I think we're hiding ourselves from the more important truth, which is that China has built an industrial ecosystem. And it is that industrial ecosystem that allows it to be competitive. And now we could say, well, it managed to build it through subsidies in the beginning, et cetera. But, we have spent the past 20 years destroying our industrial ecosystem. And China spent 20 years building its industrial ecosystem. And so to think that our problem is a lack of subsidy, that's not the problem.
Well, I should be clear. Subsidies is one thing I mentioned. It's not the only thing. What I'm really trying to get at is that in China, the government is a greater partner in the economic process in a way that the US government no longer is. So, what explains that? What explains the deindustrialization of the United States and how much, if any, of that deindustrialization was policy driven? In other words, how much of the loss of US manufacturing and the financialization of the American economy is the result of explicit policy choices made in Washington?
I think the government let it happen, but the ones who are responsible, look, is the US government responsible for the fact that Boeing can't make planes that don't have parts falling off of them? Or is that Boeing management that, focused on short-term profits at the expense of everything else? Is the US government responsible for the fact that Ford and General Motors cars are now being undercut massively?
Well, where does that come from? That's a great example. You've written about Boeing also. Where does that come from in the United States, that focusing on profits at the expense of everything else? That's just a cultural manifestation, in your opinion?
I think it is a cultural manifestation. And I think culturally in the US, everything has been done in the past 30 or 40 years to glorify money making over everything else, right? And there is, in the US, the gap between CEO pay and worker pay is greater than anywhere else in the world. The gap between the 1% and the bottom 20 is greater than anywhere in the world. Now, we could argue that this promotes creativity, that this attracts all the best talent of the world in the US, that it promotes the highest GDP growth. What it doesn't promote, though, is industry. However you want to cut it, it does not promote the building of factories, the paying of workers, because what it promotes is saying, oh, I can get a worker in Mexico or in China for a third of the worker in the US, so I'm just going to go ahead and do that. And I'm going to transfer along, as I do that, I'm going to transfer along knowledge. So we could argue, you could say, well, look, if we hadn't done this, the S&P wouldn't be where it is. It'd be half of the level. We'd have the same stock market returns as Europe or the same stock market returns as Japan, which isn't that great. Yeah, we'd have an industrial base, but houses in the Hamptons, instead of costing $25 million, would only be at $5 million. And I would say, yeah. So these are the choices that were made. And I'm not sure they were made by politicians, or they were made perhaps by default. The US just fell into it.
But it sounds like your opinion is that we would be better off with lower asset prices, less income and wealth inequality.
It's not really my job to put a value judgment on it, to be honest. I'm not a politician. It isn't really my problem. My problem as an investor is just to observe and to draw the investment consequences. Now, the investment consequence of this is that the US is deindustrialized. And for now, the consequence of this, as the US is deindustrialized and as China is industrialized, the US is saying, okay, this is a problem. We're going to perhaps put wrong causes on the problem. The reason for this is China subsidizes its industry. Instead of looking inward, we're going to blame somebody else for our own problem. And what we're going to do is we're going to put tariffs to deal with this problem. Now, here's the thing. Tariffs, I'm a free trade guy, so I'm naturally some against tariffs, but I do acknowledge that tariffs can work as a Band-Aid. If you put on tariffs and say, look, we need to build up this industry, and as we do, we're going to protect it for a little while. As it gets critical mass and we get up and running, then tariffs can make sense. But there's none of that in the US today. It's just we're going to have tariffs, and tariffs for tariff's sake just means that you're sheltering your industry, which deep down makes it worse over the long term. And so today the US is basically, I think, has a cancer and has decided, I'm going to put a Band-Aid on this cancer. And the Band-Aid isn't going to work.
So you write, I mean, the reason I'm asking these questions also is because they're central to where the electorate is today. I mean, I think whether they're directly being posed or whether they're sort of implicit in the conversations that are going on within, especially the Republican Party, they're central. And industrial policy and defense spending are part of that. You guys comment on and think about the US elections, understandably, in politics. It's important. Again, if we take this imperial model, what goes on in the United States is very important for the rest of the world. How do politics fit into your framework? And how do you follow and think about the 2024 election in the context of the US-China geostrategic competition? And how was that important for investors?
These are super important questions. So first, I'm not American. I'm a French citizen. So I don't really have a bone in this fight. So I actually, to your point, I think of it as an investor, but I'm not emotionally involved like a lot of people in the US perhaps are with this issue. And now the first point I'd say is that as an investor, you could say, well, do I really care if it's Trump or Biden? Again, I know there's big cultural differences between the two, but cultural issues don't matter all that much to markets typically. And so I look at it and I think, okay, what impact are they going to have now? Whether I look at Trump, whether I look at Biden, they're both going to run massively easy fiscal policy. Whoever gets elected, that budget deficit in the US, which in my mind is completely unsustainable, that's not coming down. It's going to stay at 5, 6, 7, 8% of GDP for as far as the eye can see. Now, they may spend the money on different things. There's going to be a lot of rhetoric difference between the two, but fiscally, it's going to be roughly the same thing. Where perhaps there is a difference between Trump and Biden is in foreign policy. So Trump splits the world between US and foreigners. And foreigners are wrong-uns. However you cut it, if you're a foreigner, you're trying to take advantage of the United States. And that was his inauguration speech. It's America first, America first, America first. Biden splits the world between good democracies and bad non-democracies. And it's a very much a black hat versus white hat sort of, Walt Disney or Western view of the world, where you got the good guys and the bad guys. Now, I think, to be honest, some of the good guys, i.e. the Japan of this world, have taken advantage of this Biden position. For me, the biggest anomaly in the markets right now is that the yen is at 155, 160. That's completely crazy. You've got the world's biggest industrial power, one of the world's biggest, second after China, running a currency that's 40% undervalued on a purchasing parity basis. It's madness. Today the yen is one of the cheapest currencies around. Like on a purchasing parity basis, it's cheaper than the Indonesian rupiah, cheaper than the South African rand. To me, that's crazy. Now, I highlight this because I tend to think if Trump gets elected, he's not going to stand for that. I think he comes in and he tells the Japanese, hey guys, 155 isn't the price, 120 is the price. And then this has a big impact on markets because the cheap yen has allowed for bond yields everywhere in the world to probably be lower than they should be. It's allowed for carry trades to continue. It's triggered a lot of outflows from Japan into gold and triggered a massive structural bull market on gold. So, that one I could see having a big impact. Otherwise, I think whether you've got Trump or Biden, the anti-China rhetoric, frankly, stays the same. Whether you have Trump or Biden, I think both actually want to get the US dollar lower. Now, Biden is less explicit than Trump on this. Trump is just out there saying, hey, we want a weaker dollar. Lighthizer, his main economic advisor, says it every day. So you've got either way, you end up with a policy of excess budget deficits, weaker dollar. The excess budget deficits and the weaker dollar combine to continue pushing yields higher. So as an investor, it's like, yeah, it's sort of same, except perhaps if Trump gets him come in, a lot of the carry trades might implode pretty early on in his presidency.
So Louis, I'm going to move the rest of our conversation to the second hour. I want to talk about something that is being discussed quite a bit now in the media, which is the RMB and potential RMB devaluation. I know you have a contrary take to that. This will also give us a chance to talk about de-dollarization, which is something I think we should also clarify conceptually, because I feel like it's a term that's used a lot and often means different things to different people. And to discuss how it fits into this larger framing of American empire and the American imperial economy, which we've been discussing. For anyone new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Louis, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Louis, stick around. We're going to move the rest of our conversation onto the premium feed. If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.